Welcome to the Capital News. I'm your host, Alex Karitis. Today is Tuesday, December 22nd, 2020. Thank you so much for joining me. The title of today's podcast, More Spending is Never Enough. I know we've had similar titles, but this is just par for the course. This just happens to be the truth. More spending is never enough. This also happens to be our 500th episode. So congratulations to you. Congratulations to the Capital News. 500 episodes already. That's crazy. But here we are. I wish I had some giveaways for everybody, but I've been crowded out by the government because the government is giving away all of the goodies. And yesterday we talked about Nobody Cares Act 2.0, $900 billion monstrosity attached to another spending bill, a $1.4 trillion monstrosity. And we said, okay, looks like it's going to be $600 per person making $75,000 or less, and couples making $150,000 or less are going to get this $600 check. Well, now it appears that President Trump says that ain't good enough. Now, I applaud the president for coming out and criticizing this bill as a disgrace, as a monstrosity, because that's exactly what it is. Although I would like to know where President Trump has been over the past 4 years with the hundreds of billions of dollars and trillion-dollar deficits before COVID-19. Because surely all of those pennies, nickels, and dimes are not accounted for. But all of a sudden he is now concerned about overseas spending and domestic pork barrel spending and all this other crap that was thrown into this $900 billion monstrosity. And I'm sure there's a ton of waste that exists within the $1.4 trillion spending bill just to keep the lights on in this country for a few months. That's all it's going to get us, folks, is a few months. All right? So you got the $900 billion, $1.4 trillion. That adds up to $2.3 trillion. We bring in about $3.5 trillion at the federal level. So we're almost already there, and we're only a couple months into fiscal year 2021. So it's not going to be any stretch of the imagination that we're going to have another year of multi-trillion-dollar deficits, probably getting us to $30 trillion at a national debt level. So that's where we are headed. So President Trump isn't satisfied with $600. He wants it to be more than that. And he wants it to be more than the $1,200 that was handed out earlier this year. His magic number is $2,000. So what is that? 3 1/3 times higher than the $600 stimulus check? So who's going to sign off on this? Well, I guess the president's going to, because that's his number. And Nancy Pelosi has already come out and said, well, we've been waiting, Mr. President, for you to give us another number because we were always happy to do more than $600, but that's what we could agree upon between the two parties. So Crazy Nancy is more than happy to sign off on $2,000. Apparently, the president is more than happy to sign off on $2,000. Now the question goes to the Republicans. Are they going to sign off on the $2,000 check? That's the big question, because now all of a sudden you have a handful of Republicans who magically have grown a spine, or at least have pretended to, and now they have become fiscal conservatives once again. They're now concerned about the wasteful spending. They're now concerned about the national deficits and the national debt. They weren't happy with $600. Are they going to sign off on $2,000? So, with the American people, many still in desperate need of some sort of assistance, and small businesses, is this bill going to actually be passed? And now is it going to be signed by the president? We shall see, but this is another hiccup. The president is still the president for another month. There's going to be a lot of drama, make no mistake about it, for the next month. So this is just another one of those situations. Now, of course, I remain against, I'm totally against all of these bailouts. Totally against them. Because this is what happens. This is the politics that get played. Where does the money come from? That's the other question. The government doesn't have money. It doesn't make anything. It takes it. And who's it taking it from? It's taking it from taxpayers. And they have to go to the central bank, the Federal Reserve, to print the dough because we are a first world banana republic because we don't have the money. That is extremely destructive. That destroys the purchasing power of every dollar that's in circulation. That printing press being turned on is by definition inflation. The question is, where does all of that inflation go? What asset classes? What type? To what degree? How quickly does it make its way there? And that's all we're waiting for. But we're already witnessing it. We have been witnessing it. People are not in the streets around the world because the cost of living is so damn affordable. They're in the streets protesting, rioting, overthrowing or attempting to overthrow their respective governments because the cost of living is too high. It is unsustainable. People are living paycheck to paycheck. Now the number in this country is north of 60%. Before COVID-19, it was around 40, 50. Now it's over 60% living paycheck to paycheck. That is in the wrong direction. This is because the cost of living is unsustainable. It is too high. I don't care what these idiots tell you the official inflation number is. I don't care what these idiots tell you about, well, yeah, they're printing money, but there's no velocity. Give me a break. Give me a break. So where's this all going to come from? It's going to come from the printing press because that's the only place it can come from. So $2,000, why not make it $20,000? That would really solve a lot of problems, won't it? I mean, if 600 was good enough, 2,000's got to be 3 times better. Well, let's make it 10 times better. Make it 20,000. Let's go. Make it 100,000. That'll solve a lot of problems, won't it? It would have to. That's the logic. Because more spending is the solution. That's what they would have you believe. And more spending is never enough. So let's just put the pedal to the metal and let's just get there already. Stop pussyfooting around with $600. That's chump change. $2,000 is nothing. Let's get serious here. Put $20,000 on the table. We can have a Merry Christmas with that, can't we? But that's not how it works, folks. If that was the solution, if it was that simple, then we would never have any economic problem whatsoever. All you'd have to do, go to the Federal Reserve, European Central Bank, Bank of Japan, whatever central bank, wherever you are, go get the cash, and that's it. But that's not how it works. Ask Argentina, ask Venezuela, ask Iran, ask Turkey, ask Lebanon, ask Syria, ask those countries if the printing press is the salvation, if it's the panacea. And they'll tell you, hell no, because it isn't. It doesn't work there, and it doesn't work here either. Doesn't matter that we are the world's largest economy. It does not matter that we have the world's reserve currency. That'll give us some time. That might allow us to get away with this stupidity for a little bit longer than those other countries. But that's all it's doing. It gives us a little more time. But it's not a solution. It's not a panacea. Don't fall for it. But that's the logic. Those are the questions you have to ask yourself. If 600's great, 2,000's got to be even better. 20,000, that ought to do it. So just ask those questions, but nobody ever seems to ask them. I wish they would. So it's going to be interesting to see what happens in Washington, D.C. This circus is going to continue. And of course, the president granted clemency and gave some pardons to a handful of characters. Again, this is what happens at the end of a presidential administration. If you do not like Donald Trump, if you despise Donald Trump, you're just going to say, look, this is just who he is. This is part of his character. This is what happens. These are the people that he's, of course, going to pardon. Just going to give you another reason to complain about him. If you like him and support him, you probably look the other way. You don't care. I'm not going to go into it because this is what they all do. This is what they all do. This is just more hypocrisy from the media if they're going to feign outrage over what the president has done. Were they outraged by Obama or Clinton when they pardoned some shady characters? Yeah, okay. So there you have it. If you want to know who he pardoned, look it up. Market performance for the day, we got the dollar index trading at 90.44, so relatively unchanged from last night's podcast. No major movements at the time of this podcast right now in any of the major currency pairs, but nonetheless, the dollar index is trading at 90.44. Remember, there are those who are saying because we were trading with a 90 handle, 89 handle last week, that the dollar's collapsing. This is not a collapse. This is a steady decline. Once we hit the 87 handle and bust through that, then it's something to be concerned about. You really want to see a decline or a major sell-off, you're in the 70s. We're not even close to that. If we get there, I'll of course mention it, but you're going to know. On the share price front, overnight futures trading, we have the Dow Jones Industrial Average down about 0.1%. The S&P 500 is flat, and the NASDAQ 100 is trading up about 0.1%. Cash trade in Japan is currently up about 1/3%. A sea of green across the pond in Europe. Of course, yesterday we had a sea of red, so a little bit of a bounce back across the board in Europe. UK markets gaining about 0.5%. German markets gaining up 1 1/3. Same for the French markets. Italian markets gaining 2% for the day. And to round it out, the Spanish markets gained 1.9%. Cash trade in Australia gaining about 0.6% right now. On the share price front, we have Apple gaining another 2.8%. Tesla, however, giving back another 1.5%. In a choppy session. Again, Tesla has been inducted into the S&P 500, but so far, 2 days in the red. Microsoft gained 0.2%. Amazon was flat, and to round it out, Facebook gave back 2% for the day. On the commodity front, we have WTI trading at $46.32 a barrel, Brent at $49.33, natural gas at $2.78. Gold and silver, a little bit of a pullback, but both are in the green right now. Gold at $1,865 an ounce, silver at $25.31. And to round it out, Uncle Sam's 10-year junk note is yielding 0.91%. So there you have it. So the other topics that I want to talk about today are some more housing data that I came across earlier today, and then we will close it off with a further discussion and analysis of the Federal Reserve's balance sheet. Yesterday, we talked about the fact that the Federal Reserve's balance sheet hit an all-time record high last week. So I just want to put some things into perspective. What does that mean? Where were we during the great financial crisis? Where were we before that? Where are we likely headed? What does it mean? Why does it matter? And we'll try to put this with a backdrop of some GDP figures and national debt as well, because it's all tied together. But first to some of the housing data. These are the 10 most threatened metros based on FHA, Federal Housing Authority, Federal Housing Agency delinquency rates through the end of November of this year. Okay, so we're talking about Atlanta, Georgia. We're talking about Houston, Texas, Chicago, Evanston, Illinois, Washington, D.C., Arlington, Alexandria, Virginia, Dallas, Plano, Texas, Riverside, San Bernardino, California, Baltimore, Columbia, Maryland, San Antonio, Texas, Orlando, Kissimmee, Florida, Tampa, St. Petersburg, Clearwater, Florida. So those are the 10 most threatened metros, all right? We're talking about nearly 8 million residencies, all right? 8 million. This is nothing to sneeze at. Delinquencies, all right? The percent of total delinquent loans, 17.5%. The percent that are seriously delinquent, meaning these are loans that are 90 days or more delinquent. So serious delinquent loans, 11.8%. So the total, 17.5%. For some perspective, during the depths of the great financial crisis, the GFC, it was at 14.5%. So this just puts this thing into scale, into context, as to how severe this economic contraction has been and remains. This is why I'm saying that we are in the midst of the greatest depression. I continue to hear on the news today, as I noted yesterday, a lot of the talk of a double-dip recession as we make our way into 2021. we never got out of the first recession. Now, this is going to be the headline. This is going to be the narrative. Oh, yes, everything came roaring back. All of the stimulus, all the central bankers, all the politicians were able to put Humpty Dumpty back together again. But lo and behold, it wasn't enough, and now we're going back in a double-dip recession. It's a bunch of noise. It's a bunch of nonsense. We never got out of the first recession that we fell into the beginning of this year, technically and officially. And we ain't getting out of it for a long time. This is the greatest depression. Everybody knows it. I don't care that the stock market continues to make all-time highs. I think that's a travesty. I think that's a slap across the face. I think that's an insult. Tens of millions remain unemployed. We have a reversal in trend with respect to initial jobless claims, getting close to 900,000 as of last week. Tens of millions still in food bank lines. It's the holiday season. But hey, NASDAQ made an all-time closing high. Who cares? The NASDAQ, we got Tesla in the S&P 500. Who cares about all of this pain and suffering? Who cares about it? Who cares about these delinquency rates? Who cares about the tens of millions of Americans waiting in the wings for eviction? These piecemeal bills, 900 billion, 1.4 trillion, whatever number they want to come up with. A little bit of an extension here in unemployment benefits, a little bit of an extension with respect to an eviction moratorium, whatever it is. These aren't solutions. It's not solving anything. And these numbers, 9-10 months into this COVID-19 economic contraction, of course, that's not the reason, but it's part of it. These numbers are worse than where we were in the depths of the great financial crisis. For a little perspective. And then you talk about home price increases, because they have this year-over-year home price appreciation for the month of November. The lowest year-over-year increase comes in at 7.1%, and that's in the Orlando, Kissimmee, Florida market. 7%. The highest in these 10 metro areas is at 13.8% year-over-year. That's in the Tampa, St. Petersburg, Clearwater, Florida market. So remember last year, folks, before COVID-19, I told you when this economy comes crumbling down, which it was inevitable, it was going to happen. I said, you watch, when the everything bubble bursts, a lot of traditional correlations are going to break down. Well, this right here is a perfect example. Because what one would typically expect to see when you have massive and historic unemployment figures, initial jobless claims figures, housing prices, real estate prices usually decline. But that's not what we're seeing. We're seeing these prices increase. This is one of those breakdowns. These markets are busted. And a lot of the people who are buying homes at all-time high prices are going to feel the burn when these markets correct and revert to the mean. They go back to the average, because that's what always happens in the marketplace. It's just a question of when. So I feel bad for people who are paying these types of prices for these homes, who are likely going to find themselves, unfortunately, underwater in the not-too-distant future with respect to their mortgage, because these prices are going to come back down to reality when all of the dust settles. You can only have record low interest rates and mortgage rates for so long to juice a market for so long. The piper's going to need paid. There's going to have to be economic activity to sustain your cash flow, your personal cash flow, your checking account, the ability to pay and service that mortgage, etc., etc., etc. And if I'm right, next year is going to be even worse than this year. Hang on to your hats. Because despite all of this, we have still yet to really see the full-on effects of a crumbling commercial real estate market as well. And that's because the Federal Reserve, in conjunction with the federal government, with their emergency policies and facilities, have thrown trillions of dollars into the system to backstop all of these losses. But that's only going to get you so far. Central banks can assist with a liquidity issue, with a liquidity problem, but they cannot print jobs. And they cannot make insolvent companies and banks solvent. And that's why I had stated several months ago and reiterated here all the time that one of the next waves coming, when the next shoe to drop, is going to be a tsunami of insolvencies and bankruptcies. And we've already witnessed a lot to begin with, especially with respect to small businesses, which are just being hung out to dry. They're not getting the assistance that they need. They're told to shut down. They're told to do XYZ. They do XYZ so they can open up. And then they get told to shut down again. Yet the larger corporations, the Amazons, the Targets, the Costcos, the Walmarts of the world, no, they can stay open. The Home Depots, the Lowe's, they can stay open. But the small businesses, they get whacked. It's all about consolidation. It's all about power. We define this and describe this and outline this in our book, The Cynic's Guide to Investing, published 5 years ago. This is the name of the game. It's always about power. It's always about control. It's always about consolidation. And we know through a podcast we did a couple weeks ago, a small biz price, a pulse check, that of those remaining, nearly 50% are going to close their doors for good if they don't receive some other type of assistance from the government. And it pretty much has to come from the government because we know that the banks aren't giving these businesses any more money. And the reason the banks aren't giving these smaller businesses any money is because the banks believe, and probably rightly so, unfortunately, that these small businesses, even if they get the loan, are going to still end up going out of business. That's how bad this is. So the banks that we bail out with trillions of dollars sitting on it can give it to these smaller businesses. That's supposed to be the purpose of it. But they're not doing it because they're going to lose money. Because, yeah, we'll give it to them, but they're not going to be able to pay it off. I mean, this is ridiculous. This is absurd. This is why you don't do the bailouts, because these are the shenanigans that happen. You get it? Trillions of dollars. But the banks are okay, right? We talked about that yesterday. The Federal Reserve says, oh, yeah, they passed the stress test with flying colors. The big banks did. The big banks did. You want to talk about commercial real estate collapsing? That's a lot of small and mid-sized and regional banks. Wait till that starts to take hold. All right? It's going to be nasty. You haven't seen anything yet. So that's some housing data. Those are some typical traditional correlations that are breaking down. Another market that will eventually collapse, unfortunately. So hang on to your hats with that one as well. So with respect, with the time that we have remaining, with respect to the Federal Reserve's balance sheet, right? Hitting an all-time high, nearly, I can round up, right? We're friends. I can round up. What the hell is a couple $1 billion amongst friends? $7.4 trillion. The Federal Reserve's balance sheet, $7.4 trillion. Of course, I'm looking at the asset side of the balance sheet, but the assets have to equal the liabilities and equity on the other side, but we're talking about the assets. And the bulk of the assets that the Federal Reserve holds within their balance sheet are, of course, treasuries across the curve, meaning different durations, and mortgage-backed securities. And, of course, a whole host of other issues, other assets that they hold as well, courtesy of the Nobody Cares Act, which is completely ridiculous. It's criminal. It's, as far as I'm concerned, it's against the law. The Federal Reserve does not have the authority to own these other assets, but it's a crisis, and there's no checks and balances, and these people aren't held to account, so who cares, right? Nobody cares. And as long as the stock market gets juiced and asset prices keep going up, nobody's going to care either. That's because this country is lost. This is part of the moral and social decay that we are experiencing, because people don't care why. As long as it's going up, Long as their price is going up, their portfolio is going up, they don't care why. They don't care at what expense. As long as that number's getting bigger, you're buying everybody off. So the $600 wasn't enough. $1,200, sit down and shut up. Now it's going to be $2,000, sit down and shut up. That's what you're going to get. So $7.4 trillion balance sheet, Federal Reserve, all-time high as of last week. I want to put this into perspective because this number, as I stated yesterday, is likely going to hit $10 trillion by the end of next year. So as we're having our, whatever it's going to be, a couple hundred, we're on 500 episodes. Next year it's going to be almost 700 and something maybe. We're going to be looking at $10 trillion Federal Reserve's balance sheet. And if it's higher than that, I wouldn't be surprised either. But you say these numbers, 7.4 trillion, well, what does that mean? Where was it during the great financial crisis? And of course, I talk about this from time to time, but I have to remind the audience of this because to me it's important, and because you're not going to hear a lot of this on Bloomberg or CNBC or Fox Business. But those are pretty much the only stations where you'll come across some of this information if they want to bring it up. But they typically don't go into great detail with it and what it actually means. So we have to go back to the great financial crisis, all right? Just to put this all into perspective, Federal Reserve's balance sheet was less than $1 trillion in 2008. It's about $900 billion. So the Federal Reserve came into existence in 1913, 1914, it opens its doors. It takes almost 100 years to get to $1 trillion. Now, you fast forward to where we are today, over the course of a few months, and we're going to get to this here shortly, we increased it by $3 trillion. So in the depths of the great financial crisis, the idiots at the Federal Reserve, Bernanke at the time, the chairman of the Federal Reserve, and surrounded by other idiots and the dingbat, Janet Yellen and all these other idiots, they say, oh, we know what to do. Let's just increase our balance sheet. Let's start buying a lot of treasuries across the yield curve to keep interest rates low, right? If you bid up the price of the bonds in the notes by purchasing them, the yields come down because there's an inverse relationship to the price and the yield. And we were in the midst of a housing collapse. So wait, let's buy mortgage-backed securities too, and that's exactly what they did. So in September of 2008, in the midst of the great financial crisis, we're at $925 billion on the Federal Reserve's balance sheet, and boom, over the course of a couple months into November, we're at $2.2 trillion. So we add about $1 trillion and a little more over the course of a couple months. Now, we talk about this too at length in our book, The Cynic's Guide to Investing, and we just ask the reader to look at this chart, look at this graph, and they say, does this look right? Does this look normal? Does this look like it can be sustained? And of course, the answer is no, it cannot be sustained. But that's not going to stop them from trying, and they've been doing so for the past decade. And now it's on overdrive because it's starting to collapse. And we'll talk about that too. But it looks like a staircase, these graphs. We've got a rise and a run, a rise and a run, a rise and a run. And now we really have a rise from earlier this year. So in the depths of the great financial crisis, we increase by a little over $1 trillion. That's our rise in this step, right? Boom. And that's quantitative easing number one. Then you got QE2, Operation Twist, QE3, etc., and you end up sort of peaking out about $4.6 trillion. And a lot of this was overseen by dingbat Janet Yellen and the current chairman of the Federal Reserve, Jay Powell, who was also there prior. Okay, he just didn't come out of the woodwork. He was part of the Federal Reserve system too. I want to say, oh, well, now finally, after several years following the great financial crisis, the economy finally seems to be getting its sea legs again. Finally on some solid footing. And then you get President Trump in, and of course it's the greatest economy ever. Well, clearly, we got our sea legs back. The president's there claiming that this is the greatest economy ever in the history of the republic, which was, of course, bogus, but nonetheless, that was the argument. Well, now, clearly, at the Federal Reserve, we can start to taper our balance sheet. We can start to allow a lot of these assets to run off. They're expiring. We're not going to roll them over. We're not going to buy more of them. We're just going to let them expire. This is it. This is finally it. We're going to let interest rates rise, and we're going to increase them ourselves. Well, we know what happened in the fourth quarter of 2018. Wall Street has a hissy fit. The president has a hissy fit. No more of that. But the interesting thing that happens the following year, which would be in 2019, and it happens to also coincide with sort of the bottoming out, if you will, with the tapering of the balance sheet. It comes also in September, but in the year 2019. What happened last year, September 2019? You remember? This is when the repo market seemingly collapsed. Something broke within the repo market. Remember, this was big news. Okay? And we talked about this for quite a while. And the repo market, just as a quick refresher, is banks lending money to each other on an overnight basis, because banks have to satisfy a regulatory requirement to have a certain amount of reserves within their vaults, a certain percentage. Well, those with excess reserves will lend to those who have a deficit, thus everybody is in compliance with the regulatory requirement. Well, that overnight lending rate is supposed to mirror the federal funds rate, which is what the FOMC sets. So when we talk about the FOMC, the Federal Reserve meeting, that's the rate at which they are setting, the federal funds rate. Well, at that time, I don't remember off the top of my head what it was, maybe 1.5%, 2%. That's what the overnight market, that's what those banks should have been lending and borrowing money at, around that figure. Well, that's not what happened. Recall? There was a huge spike. You're talking 5, 6, 7%. I think there was even 1 or 2 nights where it got as high as 10%. That is not ever supposed to happen. That is a rate that is supposed to be controlled by the Federal Reserve, and the banks are just simply supposed to say, well, that's the rate, that's what you're going to borrow at. So the fact that you had that type of an increase in overnight borrowing sent a message that something is broken, something is totally amiss here. Is there a liquidity problem? What's the counterparty risk here? This is just overnight. Am I not going to get my money back? So 2% ain't going to cut it, Jack. You got to give me 8%, 10% in order for me to give you my money to get it back the next day. Otherwise, you're going to have to go somewhere else. And I read as much as I could on this. I listened to as many interviews as I possibly could from people a lot smarter than me when it comes to the repo market. And guess what? Nobody could put their finger on what actually happened. It's been over a year, and I have still yet to hear any solid answer as to what happened. What broke? What cracked? What actually happened? But the Federal Reserve told us, well, this is just temporary. Nothing to see here, folks. Pay no attention to the man behind the curtain. And I said, well, that's a load of crap. That's a bunch of BS. This is not going to be temporary. And lo and behold, they were involved in the overnight market, the Federal Reserve, for several months, pretty much becoming the overnight market. So that's something that is still broken as far as I'm concerned, but they just don't talk about it as much. But at that time, you got a Federal Reserve balance sheet. I know I'm running a little late here, but here we go. At that time, September of 2019, Federal Reserve's balance sheet was at $3.8 trillion. Okay? You fast forward to June of this year, you're at $7.2 trillion. So over $3 trillion basically is the drop of a hat. So, little perspective again, right? $1 trillion increase during the depths of the great financial crisis. Now it's an increase of over $3 trillion in this, the greatest depression. So what we're looking at here in real time is diminishing marginal returns. They threw $1 trillion into the system during the great financial crisis when it was able to alleviate concerns, do blah, 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 blah. Now, $1 trillion ain't going to cut it. We had to triple it. $3 trillion. And we're still not done. We are still not done. So they need more dollars to be flown in and just flooded into the system in order to get that same type of juice that we saw over a decade ago. So this is ridiculous. If our analysis is correct, and it's in agreement with several other analysts out there, that the Federal Reserve's balance sheet is going to hit $10 trillion by the end of 2021. What that in effect tells us is that their balance sheet, the assets, they increased their assets tenfold over the course of 12 years. Wouldn't you like to increase your assets tenfold over the course of a decade? Wouldn't that be nice? Well, when you have a printing press, you can do that. This is how destructive this is. This is a joke. Now, this is free information. You can look this up, the Federal Reserve economic data. You don't have to believe me. Look at this data. Look at these charts and graphs. You don't have to be an economist. You don't have to be a mathematician to know that something is amiss here, that this is unsustainable, that something has to be broken, that this cannot continue. But they're going to do what they can to continue this because they are never going to admit that it's unsustainable. They're never going to admit that they have made a mistake. But guess what? This is an economic experiment, and we are the rats in the maze. I'm sick and tired of it, and you should be too. And we got these clowns and jokers in Washington, D.C. playing with our lives and using our money to do it. It's time to wake up. So there you have it. More spending is never enough, and we're just getting started. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.